Hi folks, welcome once again. Another Tuesday evening. Great to see you on. I'm going to put the shisha on just a moment or two and we'll let people make their way in. Important conversation this evening about what's going on with regard to households and their finances, but we'll also touch some of the broader issues too. There's so much to talk about, of course, and the last couple of weeks in particular have been quite a ride. However, before we get into that, for those who may not know, this is the studio setup we've got here with the various elements that make the show work. It's quite complicated, but it's all sort of working together. So I have a couple of computer screens that I can present material. I've got the multi-view, I've got the chat, I've got the stream going out live over there, and the other computer over the other side is actually controlling the streamer, which is a separate box. And seems to be working well. And of course, we have the doggies. They are here. Meteor's decided to spread out, so I had to zoom out slightly to get the full shot. They've had their morning walk, they've had their breakfast, and now we're back. So it's all good, really. And I'm looking forward to the conversation tonight. It'll be very interesting. Anyway, I think we are pretty much on time. So I'm going to take the pre-show off. I'm going to start the show and I'll be back in just a moment. Hello there, it's Martin North here from Digital Finance Analytics, one that is Post, covering finance and property news. And of course, tonight is our live show. So great to have you on. And it's very important that we have this chat tonight because there's so much good information that my modeling produces that, well, I don't get time to share really because there's just so much else going on. However, I thought there was a few other things we should touch on the way into this show tonight because things are, well, interesting, I think is one way of putting it. So here's just a little intro to give you a little bit of a sense of what it's like over here in the UK at the moment. This is actually my morning walk and the sun was shining through the leaves this morning. So it shows you that it's autumnal-esque. And as Otto actually said, the days aren't getting too cold, are they? Well, it's a bit colder, but it's beautiful autumnal weather. We've had several weeks actually with almost no rain at all, so it's quite attractive. But the leaves are now falling, and I think we're going to find it's going to be a bit colder going forward. So that's the really good news. The world out there still looks quite nice. However, the world closer in doesn't look quite so pretty, I'm afraid. There's a lot of rubbish going on at the moment. And here's just one place to start. Of course, we've got this social media ban thing going on at the moment. And this isn't about just those under 16-year-old. This is about everyone being identified to suit the government's dystopian agenda. At least that's what Campbell Newman said. And I don't think I disagree with that. So quite concerned by that particular angle of attack. And of course, we've also got the misinformation, disinformation bill, which is still ploughing on. It got passed in the lower house. The Senate inquiry is continuing. They had around 20,000 submissions to this inquiry, but it doesn't actually going to make a lot of difference, I think. It's quite interesting just how broad the criticism is of this bill. As David Coleman said, top lawyers like Anne Toomey sounded the alarm. I'm worried that in the process of ineffectively trying to do this, we create worse problems through large-scale censorship of contested views and the undermining of democracy in the name of cleansing it from misinformation. I think that's exactly right. And here's another one, new thought experiment. Under this bill in the 1400s, the idea that the universe revolves around the sun would have been flagged as misinformation under the Ministry of Truth. And it's interesting also that the Victorian Bar Association put in a strong submission saying that no, this wasn't a good idea, but somehow it got massaged in the process. And as Robbie said, the drafters of the mad social media censorship legislation copied and pasted the Victorian Bar Association language, warning the bill was unworkable into the explanatory memorandum, but flipped it to claim the opposite. So they've been caught out. And there's another sort of thing going on here with the signatures now. Well, it was 37,500 on a petition that's there at the moment, stopcensorship.com.au. And just to give you the full picture, amazing that one of the legal voices that has been calling this out has now been blocked by the Minister of Censorship, Michelle Rowland, for criticising her misinformation bill, a portent of things to come if the Orwellian bill passes. And of course, Craig Kelly, always on the front foot here, talking about the costs of Canberra. And in the last 2 years, the number of Canberra-based bureaucrats has increased by 17,400, up 13%, and it's costing 15.2 billion. So I rather hope that you feel we're getting value from our politicians. I have to say that I find that things are quite concerning. Now, when it comes to some of the more specific information that I've been looking at, there's a lot to talk about. And you may or may not have seen, I actually put a post up over the weekend, property market caught in higher rate trap as parents help to buy more. That was some analysis, particularly on the bank of mum and dad and the bank of grandparents and siblings who are helping more first-time buyers to try and get in the market at pretty much a peak of the market, I think, and that's a risk. There's also, of course, the dark shadows overhanging the rate cut decisions now, as we'll touch on a bit later, because with Trump coming in, with more inflation now expected, with trade wars and other things probably bubbling along, that'll make it much more difficult to drive rates lower. And of course, as I reminded everybody in an earlier show, although it's the economy stupid, all of this focus on misinformation and disinformation and all those other things, you're missing the critical point. The economy in Australia is not really working for ordinary people. And if you want some evidence of that, here is, of course, the killer slide. It came up on the ABC the other day that shows that the gross household disposable income per capita in the US is rising compared with 2022, but falling dramatically in Australia. So on an individual basis, we are significantly worse off. And another way of looking at it is your GDP per hour worked. And you can see there that the Australian story is going in one direction. The Australian story is going in the other direction. US in one direction, Australia in another. And I put this one up. This is an oldie but a goodie, which just shows that this idea of less capital deepening, slower productivity, the GDP per hours worked falling, things are not well. And just as another micro example of that, if you look at the Sydney water indicative bills over the next 10 years, they're looking for significant rises just at the basics of water. And wherever you look, prices will continue higher. And interestingly, Infrastructure Australia some time ago called about the population growth and climate change as well, putting significant upward pressure on real household water expenditure. Maybe by 2067, we'll be paying $6,000 for, water and sewage. And just on that, Tarek picked up this, and it's worth just reflecting on. These are issues on financial pressure having huge consequences. So Australians hoping to start a family are delaying or giving up entirely as the cost of housing skyrockets. And if policymakers have their way, we will follow South Korea's strategy, which is doing nothing. The point I'm trying to make here is that there are huge implications of bad policy that's been run out for the last 20 to 30 years, making housing unaffordable. And it's the falling out in terms of wealth, it's falling out in terms of quality of life, and even the future, if in fact we have less in the way of next generation being produced. And yet, the ABS data today showed that the statistics on international travels arriving and departing were up. Short-term visitor arrivals up 7.9%, short-term residents returning 8.7%, total arrivals up 8.1%. And interestingly, departures are also up a decrease of 13%. One of the things I'm seeing in my surveys is people who are actually deciding to leave Australia simply because they can't make it work here. And I think we're going to see more of that. But if you look at some of the other numbers, you can see there that the number of higher ed students is up again, significantly up actually. The number of students arriving in September 24 was 4.3 higher than the pre-COVID levels back in September 2019. And frankly, that's the story, really. So from a contextual perspective, we have very high migration. We have very high costs continuing to rise. We, of course, also have the question of where rates are going to go. And it is worth noting, of course, that the hope of a rate cut has pretty much evaporated. As this article said, the Reserve Bank is poised to resist signs that price pressures are evaporating, hold interest rates steady for the rest of this year and beyond. Now, this was written when people were thinking next February, but after the Trump results came out, that's now been kicked out and it's now much later next year probably. And whilst electricity was down, of course, that's all to do with subsidies, and those subsidies don't really make a difference ultimately. And as I put this up one yesterday with Edwin, how will it hit our region? People are trying to work that out. Of course, the deportation of illegals in the US, whatever it costs. And there was an article that said that the trade wars may even force the RBA to lift rates. A global trade war triggered by Donald Trump's proposed tariffs would push up the price of goods around the world and put pressure on the Reserve Bank to increase further interest rates, wiping perhaps $12 billion off mining exports. And various people were quoted there from the National Australia Bank chief and from KPMG. And of course, Chalmers came up and said, no, everything's fine. We've got it under control. I'm not quite sure that's really the full story. And certainly other articles suggest that the tariffs could mean a clash for Australia and AUKUS maybe even at risk. And there was an article the other day saying that, this could be disaster for Darling Downs with house prices potentially under the pressure of, higher cost of living and things. So wherever you look, it's an interesting question. And this article said it's more than a headline, Jim. The fact is that these focus from Chalmers on the headline inflation rather than real inflation is a big deal. And I've done some initial analysis here, and from my surveys, most people are seeing still inflation sitting somewhere between 8 and 12% compared with a year ago. And that's because of the cost of insurance, the costs of higher mortgage rates or rents and other things too. So the cost of everything continues to rise. And so the real CPI is way off what the official number is. And interestingly, there was an article today coming out from the UK talking about the unemployment rate and the fact that in the UK, they can't get good data on unemployment now. I think that also mirrors what's happening in Australia. I'm not sure that the true unemployment rate is being reflected in the official figures. So for all those reasons, we are on uncertain territory in terms of what may be arising ahead. However, it's also worth noting here, NAB said that arrears were up, the highest since 2020. And whilst ANZ said that the rate cuts will be later and fewer, they also said that mortgage stress is now falling from its peak. Well, I'm not sure whether that's as true as that they would like it to be. But the bottom line is that I think a lot of households are in significant pressure at the moment. And we're seeing this in our surveys. And honestly, whatever I see makes me more concerned. Again, not everybody is in this boat. There are lots of people doing it really well, and they've still got big wage rises, and they've got plenty of savings, and they're doing fine. But there are more and more people in the squeezed middle, as well as those at who have been in some difficulty for some time. So this is not a comfortable position to be in. And there was also this headline the other day that said that housing supply might well ease price pressures because there are more properties coming on the market. There was a 13.7% increase in homes for sale in Sydney last month, according to CoreLogic, and they quoted some particular areas where, in fact, things were quite strong in terms of listings. Not universally, of course, not all types of property, but even in places like Blacktown on the Central Coast and Sutherland, listings were up. And I used this yesterday with Edwin too, but just to reiterate, Louis Christopher said that the CBD residential property listings are the highest level since the records began in 2010. That, of course, is a load of apartments. So that's something which I'm seeing. And the listings are definitely being led by relatively unexciting unexciting apartments, with also a lot of people still seeing their strata fees going through the roof. And that's another inflationary pressure that's not being caught. The other one that I'm seeing is people paying a lot more in terms of tolls to get around, particularly from Western Sydney. And that is a cost of living that, again, is not fully captured, I think, in many of the pieces of analysis that are done. And whilst the fuel price may be down a little, the other costs of running around is still pretty high. And particularly some of those tolls, it's remarkable, really. Oh, and by the way, just to give you a little bit of a context here, there was this article which I thought was quite interesting that said that Battlers Home fail. 2,500 social housing properties are sitting empty across New South Wales amid a cost of living crisis that sent the number of people on waiting lists soaring. And Parramatta saw the number of empty homes rising to 332 social houses, as well as Campbelltown, City of Sydney, Blacktown, and others. This is, again, another sign of significant leadership failure from government in terms of dealing with the housing situation that we've actually got. So it is not a happy story, really. And this takes us quite conveniently on to just share with you some of the top level research from our models. For those who haven't seen this before, we actually run our core market model. We survey households on a rolling basis, 52,000 each year, just over 4,000 each month. And that allows us to slice and dice the data lots of different ways. So we can look at it by type of property ownership and location and all those things too. All of that is there. And we can put it into our core market model and also form a view as to what may be happening ahead, thinking about the future scenarios. So we'll touch on scenarios tonight as well. And that means that we can take the information together and think about mortgage stress, the price trajectory, what's going on with buying and selling intentions, the migration data down at the postcode level, and also the CPI, the economics, the wages, the employment, put it into the core market model and form a view at both postcode and rolled up to a region, state and all Australia level, and form a view as to where things may be going. Oh, and by the way, if you are interested in having a one-to-one conversation with me, I do have quite a few of these running at the moment with people trying to work out what to do. We can't provide financial advice, of course, not qualified to do that, but we can share our information down at an individual level. It's a 30 to 40 page report on the individual postcode or suburb. And we can talk about the stress, the home price information and where things may be going. It's about an hour's conversation by Zoom or phone, and there's a cost involved because it does take a lot of time to put this information together. If you're interested, you can contact me by the blog, details in the comments section below. And I'm booking 3 to 5 weeks ahead if you're interested in that. Anyway, let's look at stress. And just to remind you once again, there are lots of different definitions of stress, but I use the cash flow definition, money in, money out. So that means if households have more outgoings than income, we define them as stressed. If they have the mortgage, then they're in mortgage stress. If renting, they're in rental stress. And of course, investors are also in this as well. If they've got cash flow pressures, we identify them as stressed investors, or if they're trying to sell their investment property. A lot of the properties being listed at the moment are investment properties. And we can aggregate it up to look at financial stress, which is the total of all households in a particular area. And we look at it in percentage terms and also counts. Generally, I believe that counts give a better sense of what's going on because the counts are about numbers of people, but percentages can be quite interesting, and I may share some percentage information tonight. Now, the RBA some time ago put this slide up, which talked about the spectrum of household financial stress from initial budget pressures through to missing payments, through to insolvency. And of course, the banks only really focus on the insolvency story. Insolvencies are up, but not dramatically so, but they are rising. But I'm measuring it at the mild end of the funnel, as it were, where there are budget pressures, where people are having to make significant decisions about what to spend money on or not to spend money on, and trying to prioritize. And that's what I'm measuring. So the prioritization, the giving up on certain things you might want to spend money on. So have you got enough cash flow to meet all your requirements? Excepting, of course, one-off things like going on holidays. I don't count those, but it's basically day-to-day spending. And unfortunately, we're seeing significant stress building there, and it's flowing across, not all households, of course, but quite a few. So here is the stress data for October at the top level. First thing to show is that the rental stress is up again. I keep coming back to rental stress. This is a huge, huge impost on a third of the population. that are in the rental sector. There was a report today saying that more people are expecting to rent for the whole of their life, and they have an aspiration to buy a property, but also almost certainly won't be able to. So 76.9% of those in the rental sector have cash flow pressures, and mortgages at half. So half of those with a mortgage, it's wobbling around 50, up, down a little bit, but about half of those with a mortgage are in difficulty. Compared with in February 2020, before COVID, we were at 32%. So there's a significant rise there over that time. Oh, and by the way, the RBA continues to report the debt to income ratio. It's very high, 186. But the fact is, of course, that includes all households, whether they have a mortgage or not. The real debt to income ratio for those borrowing is closer to 6 times, which is very, very high compared with the 3 that it used to be. So here are the top level results for October. And as always, I show them across the states first, both in counts of households and also in terms of mortgage stress. Now, the first thing I want to highlight is that we're seeing a growth in the number of households. So because of the high migration and because of more household formation at the moment, we are seeing the total number of households rising. Overall, looking at mortgage stress, it's at 49.96, so close to 50% in October. For rental stress, it's 76%. For investor stress, it's 16%, and overall financial stress, 47%. And it's worth highlighting in yellow where it went up from last month. So in terms of stress, mortgage stress, it went up in New South Wales, the NT, South Australia, and Tasmania. It went sideways or down in the other states. Rental stress was up in the ACT, the New South Wales area, South Australia, and Tasmania. Down slightly or sideways the other areas. Investor stress up in New South Wales and Tasmania, down slightly in a couple of the other areas. And overall financial stress, it's higher in New South Wales, the NT, and Tasmania, and sideways or slightly down in the other states. Now, it's worth saying, just to be clear, that we do sometimes get some movement because, of course, the survey is looking at real people. We gross it up, but as the input data changes, we do get a little bit of movement. So I say plus or minus 1 or 2%. You're going to see that, but you can see the underlying trends if you look over the longer term. And just going back to that overall position, that means that we've got more than 1.8 million people with a mortgage with cash flow pressures. We've got 2.3 million in the rental sector with cash flow pressures. We've got about 497,000 investors with cash flow pressures. And overall, of the 9.9 million households, 4.7 million have cash flow pressure. So just under half. So the other half doing okay. But of course, a lot of these are actually significant. And as always, I highlight the top one. You can see here, young growing families right at the top of the list there for mortgage stress, 89%. That includes a lot of first-time buyers. We also see quite a few on the disadvantaged fringe and what I call the battling urban. So they are leading the way. And if you look at the numbers, you can see there that, that the total for the disadvantaged fringe, 483,000, is quite a lot higher than the 288,000 for mortgage stress for young growing families. But the percentage is not quite so high. If we then look at rental stress, we see that the first generation Australians, those coming in and renting when they first land in Australia, are actually right up there. But I have to tell you that these rental stress numbers are relatively high across quite a few cohorts, from young growing families, the young affluents, some of the wealthy seniors, and even some of the stressed seniors, as well as the battling urban and the stable families too. Stressed investors, well, they're sitting, of course, with those with higher portfolios of property, so that more wealthy people generally, exclusive professionals, and the young affluents, 28 and 25%. Others there also are feeling it. And overall financial stress, you can see there that young growing families are right at the top with 2/3 in difficulty. So that's where the pinnacle of stress is. But we're also seeing it across many other cohorts too. And even those more affluent households, and I look at the wealthy seniors, I look at the young affluents, more than 50%, exclusive professionals, more than 50%. So there are quite a few people in quite a few areas which are actually being impacted. Now, if I get on briefly then to look at the top counts of stress. This is mortgage stress. Liverpool is the leader, 2170 with more than 12,600. Then we go across to the west to Wanneroo, 6065. Back to Campbelltown, 2560. Roxburgh Park in Victoria, which includes Craigieburn and Donnybrook. Then to Toowoomba in Queensland, 4350. Then back to Narre Warren, Fountain Gate in Victoria, 3805. Then Pakenham, 3810. Berwick and Harkaway, 3806. Back to Camden, 2570. Then Ballarat, the regional area, 3350. Hoppers Crossing, I should say, 3029. Riverstone and Box Hill, 2765. Cranbourne in Victoria, 3977. And Merriwa, Tamala Park in WA, 6063. And even there, we've got more than 8,400. So that's where the hotspots really are. The various percentages, you can see some quite high, some close to 100. Again, when it says 100%, that's plus or minus a bit because it's rounded up. But what it says is that quite a few people in those areas, probably most people, are having to make hard decisions about where to spend what they've got in terms of income coming in. On the rental stress, Melbourne still leading the way with more than 14,000. Then Liverpool, 2170. Toowoomba, Westmead in New South Wales, 2145. And then Southport and Labrador up in Queensland, 4215. Coomera in Queensland, 4209. Hoppers Crossing, Waterloo, Campbelltown, Derrimont and Point Cook in Victoria, Bundaberg, Blacktown, Mount Druitt, Parramatta and Ipswich and Gosford just there at the bottom. And you can see there that we go from more than 14,900 down to about 8,900 across there. So that's where a lot of the pressure is in terms of counts. Again, looking at the percentages, they are quite high, but not universally so. If I then look at the stressed investors, and this is where it gets quite interesting. So these are people now very much thinking they need to get out. And so we're seeing people in WA 6149. Now, some of these bought 4, 5, 6 years ago and are still finding it quite tough because the costs are just rising through the roof. Strathfield in Sydney, 2135. Bundaberg again, Hornsby, Toowoomba, Cranbourne, Southport, Lane Cove, Surrey Hill, Westmead, Chipping Norton, Narrabeen, DY, and Ferntree Gully in Victoria. So those are some of the areas where property investors are under most stress, and in some cases, they'll be looking to try and sell what they have. Some of those, of course, are units, some of those are houses, but generally, what we're seeing is more stress amongst units rather than houses. And finally, the overall financial stress, the aggregate number, you can see there that the winner this month is Liverpool. 75% of households there in financial stress. And that is, of course, cash flow pressure. Toowoomba next. And then we've got Campbelltown, Lima, places like that. Then we've got Tunny, Roxburgh Park, Derrimont and Point Cook, Cranbourne, Ballarat, Mount Druitt, Melbourne, Westmead, Ipswich, Wanneroo, Narrabeen, Blacktown, Pakenham, Southport and Belwood Park. And I'll just highlight a lot of these are these high growth corridors, a lot of relatively new properties that have been built and probably built down to a price. A lot of people highly leveraged with big mortgages or with big rents, but it's not universally that. So even towards the centre of Melbourne, for example, I showed there was pressure there. So that's a story. And just while we're talking, I can also talk about the risk of default for the mortgage holders. We are seeing default risk rising. This is my projection for the next 12 months. And we're seeing places like Cranbourne, Mamborough, Roxburgh Park, Success, Armidale and Tarnit and Derrimont right at the top of the list, plus Wanneroo, Bundaberg, Gosford, Pacific Pines, Toowoomba and Mackay. Expect to see default rates rising in those areas. The risk of default is still relatively low, but enough to make a difference. And for me, these are quite important characteristics that are going on at the moment. And again, not all households are in the same boat. There are some doing a lot better. Some in these areas are doing a lot better. But it does show you some of the pressure that we've got. So what I can do now is just briefly transition and talk about some of the information in my data set through the maps. And I will just share a couple of maps. We won't go a lot of mapping today because it takes too long, but I will just show you. This is the Sydney map for mortgage stress counts. And, as always, you can see there that it does vary. As we pull out from the centre of Sydney, you can see there that there is more pressure in terms of, this is counts. And we can see there that Lane Cove and places like that and Riverview 2066 are more pressurised. And in terms of counts, as we pull out, you can see there that as we go, we can see that, well, as we go west, as always, it's the people over in the west that actually have the higher density. Now, the population densities are much higher over in the west, and that's one of the reasons why we've got these higher counts. And it is quite interesting and informative to sort of just make some comparisons between the percentages and the counts, and I'm going to do that today. So that's the story, and you can see there that places like Campbelltown, Liverpool Way, 2170, up the top there, around the hills, they're all in some difficulty. Now, if I then switch and go to the percentage, and I'll do it for Sydney here, you get a rather different story. So this is the percentage of households with cash flow pressures. And the immediate observation is we've actually got more people over in the east with difficulty. So the percentages go from 7% and below with the blue and 90% plus in the bright red. And you can see that there are quite a few over in places like Vaucluse, Bellevue Hill, as well as Strathfield. And again, Lane Cove, even Cremorne is showing up there, and some of the other areas in the west. And as we pull out, again, what we see is significant pressure. Again, in the west, as you would expect, so places like Fairfield, as well as Liverpool, Campbelltown, places like that, Blacktown, Hawkesbury. So here we have high proportions of households. Now, these cash flow pressures may not be severe, but they are meaning that people are having to make tough decisions about hunkering down, perhaps putting more on credit cards, perhaps grabbing a payday loan, perhaps cutting back on other expenditure. Doesn't mean they're going to default tomorrow, but what it does mean is that there's pressure. So it's worth just reflecting on the fact that the percentages and the story based on the counts do tell a slightly different story. And if I then go to another area of the country, why don't we go to Melbourne? And I'm going to start because I'm in the percentage file here at the moment. Let's go to Melbourne, which is 3,000. Okay, so this is the percentage of mortgage stress in Melbourne, and you can see there that the areas in and around the centre of Melbourne where the percentages are reasonably high. We're not at the 90% plus until we get up to 3078, which is a particular hotspot in terms of pressure. But as we pull out, we can see there that the percentages up in the Moonee Valley area are quite high. And as we pull out further, again, what we can see is that there are more and more people in some difficulty. So to the north of Melbourne, and then to the east of Melbourne, up towards the Yarra Ranges. And then we've got people further out, of course, also in some difficulty, and places like Ballarat are there too. So in percentage terms, it's worth just noting where those hotspots are. And again, it's not saying they're going to fall over tomorrow, but it means there are a lot of people in those areas with significant pressure. Now, if I then switch back to the stress data, recent files, mortgage stress, go back there. And again, I need to go back to Melbourne. So this is now the count in Melbourne. And you can see there that the story is a bit different. So not so much pressure from a count perspective in and around the centre of Melbourne, but as we saw, higher percentages we pull out. And some of those areas to the north were actually quite high in percentage terms, but in terms of count, because of the low density of property there, it's not so serious from a count perspective. But as you go out, Wyndham sort of stands out, Point Cook. And as we go further out, we can see again the same sort of stories with places to the north, places to the east, and Ballarat also is there too. So it is worth comparing the two. And I will just do one more. I will go to the west over to postcode 6000. And we'll just do central Perth and pulling out. And central Perth is quite interesting. Again, quite low levels of stress, so quite a lot of blue. As we pull out, we start to see some of the other colours coming in, both to the north and to the south. And in fact, 6107 stands out, 6065, Wanneroo, and places like that. And as we go out further, 6030, and also further down as well. So these are the stress counts. And, there are some hot spots. But if we then do the same, but we look at percentages, we get a slightly different view. And so we'll open the percentage file again. Go back to the 6000 postcode. And again, this is now an important difference because it shows you that population density also actually has a significant impact. So West Leaderville, for example, 6007, is a low population area from a population density perspective. But you can see there that there are a number of hotspots even closer in. And so it is quite interesting. Netherlands, for example, is there as well. If you go up north, you can see Scarborough, Wembley Downs. And here's a real hotspot to the south around Kenwick, Wattle Grove, Queen's Park. Fremantle is a bit hot as well. And you can see there are some other areas. So the point I want to make to you is that both views, both the percentage and the counts, are quite relevant. And if we come down to the south of Rockingham, down towards Mandarin, places like that, you can see there that the hotspots are really something. So again, the lower population density might show you one thing, but when you look at the percentages of households in difficulty, you get a very different story. Well, that's enough on the mapping because, I can go on and show a lot more, but I probably won't have much time to do that today, bearing in mind that we're moving through, because there's another angle here, and that is what's going on with property prices and my scenarios. So let me go back to my presentation. And I want just briefly to recount to you what CoreLogic said about property prices. They did actually make the point that the values were nationally up higher, but we are seeing a bit more of a slide. So we saw the 3-month moves down in Sydney. Melbourne actually moved slightly up, but were negative still. And you can see here that at the month, we had a bit of a change in Sydney. This is actually 3rd of September, sorry. This is a slightly older data. But now we know that things have actually moved slightly worse. And the 3-month rolling was actually quite interesting. So what we were seeing was falls in Melbourne, falls in Sydney, lower momentum in some of the other places. And in fact, I made a show on that. If you want more detail on that, go back and check out the other show. But there is some interesting trends going on there in terms of what's going on with regards to property price movements. But the most significant factor is that prices at the top range are falling quite a lot faster than prices for the more affordable properties. And that's because first-time buyers are still there, still buying a bit of property. And in some cases, of course, with the help of the bank and mum and dad, I mentioned that show earlier at the top of the show. And we are seeing more than half of people with first-time buyer aspirations looking to the bank and mum and dad to help. A lot of bank and mum and dad bank contributions are more than $100,000 in cash, quite often even quite a lot more. So if you are fortunate enough to have affluent parents, maybe they've got property, maybe they can raid some of their superannuation to help, then you can get in. But if you aren't, if you haven't, then you can't. Now let's talk about my scenarios. We've updated them, of course. Reminding you again, scenarios are just a way of looking at what's going on. They're not trying to predict the future. They're showing about sensitivities. And so we have the 3 scenarios, the Goldilocks, which is that we see rates at 4.35%. They fall later in 2025. Even CBA is now saying it's going to be 2025. Is it February? Is it May? Is it July? Some of the latest are now saying July. And we see wages rise a little bit. No recession. Migration remains above average, though. That's sort of the baseline, best scenario. My baseline soft landing scenarios, we got them through 4.35 through 25. Inflation does fall, picks up again a bit later, but does stay above target in until 2026. That's pretty much what the RBA is now saying. No recession in Australia, but we see migration falling. I have to tell you that I think falling migration is only at the margin at the moment, as I showed you earlier on. The worst case scenario, though, is that we get rates rising, so they go higher, above the 4.35% in 25, and that puts mortgage rates up higher. And they stay high even in 2026 because inflation still hangs around, but we see rising unemployment. We see wages growth stalling because we find that we actually get a real recession, not just a per capita recession. We get rate cuts, but then, of course, it's too late. Migration, in the meantime, falls. That's the nightmare scenario. Now, those are three among many, but it does give you a bit of a flavour. And, of course, with the imposition of tariffs and the expectation that that is going to put pressure on inflation and potentially reduce economic activity and growth, the worst nightmare scenario might be more likely than when I ran the model, which was just before the results from the election. Now, what does that mean? Well, here are the price scenarios for Victoria. So even in the best case scenario for houses, I'm not seeing much growth over the next 3 years. The base case is a fall, maybe 17% over 3 years. The worst case is a very significant fall of 38%. Now, I'm not saying prices are going to fall 38%, but I'm saying if some of those things play out, you could expect significant downside, and units pretty much follow on. Victoria is leading the way down, in my view, and will continue to do so. And, I had a debate last week with Chris Bates about Melbourne property prices and whether Victoria was a place to buy in. I think people need to be very careful. I think prices will continue to ease down. If I look at Western Australia, though, on the other hand, the best case scenario is still further rises and quite significant rises. However, the base case, which is perhaps where I think is more likely, is we're going to start easing some of those. There will be some growth over the next few months, but over the next year or two, we'll start to see it turn and it'll go sideways. The worst case, still a fall, but not such a significant fall, maybe 21%. Units pretty much following on. They tend to be a little less sensitive to some of these situations, but not remarkably different. We could look then at New South Wales. So basically, there is a small incremental rise of 9% over 3 years in the best case scenario, but the base case is a fall of 9% and the worst case scenario, 30%. Units pretty much following on. And if we were to look at Queensland prices, stronger, 16% in the best case, but a small fall of 2.9% in the base case and a more significant fall of 23% in the worst case. And units following along. South Australia, still so upside, but the base case is pretty much sideways and there's a 21% fall in the worst case scenario, units following along too. The ACT, pretty much flat in the best case scenario because I do expect more pressure on the government spending, and I wouldn't be surprised to see a reduction in the number of people working in the public sector. It's been growing very fast, as I showed earlier on, but that could be turning. The base case is a fall of 17% and the worst case a 37% fall. That's unlikely, but again, it shows you the sensitivities based on my modeling. Units pretty much following along. And lastly, the NT, very small sample, so don't take this too seriously, but it shows you that, there is an upside potential because of the lack of supply of property in the NT, if the demand is strong. Base case is flat, worst case is a bit of a fall, and units following along behind. So I guess my main point here is to show you that there is a significant variation based on different locations. And of course, I haven't pulled out units versus houses. They behave quite differently. And the fact of the matter is that this different behavior will actually have significant impact based on the focus that we can likely see in those areas. So in some areas, expect to see significant pressure, probably sooner rather than later. But I have to say that the expectation of the sort of performance we've had for the property market since the COVID intervention with massive government support and stimulus, ultra low interest rates, and very free bank lending, that's all turning around a little bit. And the average borrowing power for the typical first-time buyer is down about 40 to 50% from where it was at the best, which means that people can borrow less. And that's with the banks still being quite generous. The banks, of course, are also supporting bank borrowers by effectively providing hardship schemes and extending the mortgage period over a longer period, which means that people pay more interest over a longer period of time. But that extend and pretend process only runs for a certain period of time, and we're now seeing this beginning to start to bubble out. And interestingly, Westpac, in their recent evidence relating to whether the 3% buffer should be changed, reduced, did concede that first-time buyers were more likely to default compared with others, and the number of people with first-time buyer status were much higher in terms of risks to their portfolio. So they weren't in favour of the reduction of 3% buffer, which I thought was interesting, whereas some of the banks are absolutely preaching the gospel. Well, there we go. That's pretty much stake in the ground. That's what's been going on. That's what my model is showing. Now, what I'm going to do is have a quick look back at the chat and see whether there are any issues I want to cover. And then what I'll do is to go into some of the specific postcode analysis, because I've seen quite a few people asking for information about postcodes, and I was happy to try and help with that. Now, I must tell you that because the chat is quite active, some may have dropped off the top. I apologize, but I can't do everything at once. This is an interesting question here. Does lower RBH rate mean banks lower their rates? Not necessarily, because the costs of funding from the banks are actually continuing to rise at the moment. And of course, what's happened there is that quite a few of the banks have been quite generous in trying to push more people in to borrow more loans. But if you look at carefully at the margins they're actually making, they're getting compressed. The way they're solving that is to take the deposit rates down relative to the mortgage rate. But I wouldn't be surprised if we see banks being a bit sticky with regard to those mortgage rates, even if in fact the trajectory was down. Cookie Boy of course refers to tariffs. Could have quite a significant impact, right? So it would slow the impact potentially of Chinese economic activity. That means we will be shipping less stuff to China. They probably would look for other markets to try and sell stuff to, so they might push some of the cheaper stuff back into Australia unless we responded with some tariffs too. But also it may have an impact on migration. The US situation with regard to kicking migrants out, those who actually don't have the papers, could lift the costs because it will actually increase the costs for labour, because there'll be a shortage of labour. And so demand supply suggests that could actually put prices up. And of course, with tariffs, who ultimately pays? Well, ultimately, it's the people who buy stuff. So consumers, at the end of the day, get caught with this. And that's the point. Tariffs are never a really good idea. But of course, you do have situations where some countries have already started for EVs in Europe, for example. And we're going to see more of this. And, people are bemoaning the decline in the world order and open borders and open tariffs, open trade. That's probably right. On the other hand, I would argue that open trade is not necessarily that great. I'll tell you some of the free trade agreements that we've signed up, I think, have not been beneficial for Australia overall, is my view. So, but tariffs, a really big deal. And, the bottom line is this, that this is going to play out over months, not weeks. Trump doesn't get in until January. And interestingly, Cookie also posed this one. I wonder how many investors are thinking of selling because Trump has been elected. Actually, in my surveys, investors were already near the end of their rope when it comes to cash flow. So the point is this. Investors, if they see significant capital appreciation in their properties, tend to hang on thinking, well, that's okay because I can always sell and get out. But now property prices are beginning to ease back in some areas, particularly some of the high-rise apartments in Sydney, for example, where values are continuing to fall. At the same time, strata costs are going up, interest rates remain high. And so for many people, the costs of trying to let that property out, the management fees are also going up too, by the way, as well. So talking to somebody the other day about that. It's becoming less and less easy, more and more difficult to be able to manage the costs. And the bottom line result of all of this is that more people are saying, well, I'm losing money. And then they look at other investment opportunities, whether it's Bitcoin or whatever else. And you think, well, hang on a moment, maybe there are alternatives that are actually better for me rather than investment properties now. And so some of the sassy investors have actually been switching over the last few months. We're seeing some of that, particularly in the Hobart area. We're seeing it also in some of the areas around New South Wales. And of course, the first rush to the exit was actually in and around Melbourne. So some of those investment properties that are selling are actually those with a little more likely to be able to yield capital appreciation. In the Sydney market, where you've got a lot of apartments with lower capital values than previously, investors are stuck because essentially they can hold on and hope that values will lift up again, but lose money in the process. Or they cut their losses, get out, and look for other opportunities. And so that's one of the hard conversations. I've had a couple of conversations with one-on-ones over the last couple of weeks, trying to get people to think through the scenarios and think through what may be done. But when you actually put all the numbers together and look at the money in, money out for the investment property, ignoring the capital appreciation, nationally, more than half are actually underwater. And in some areas, it's considerably higher than that. So that's a significant factor in all of this too. Okay, I'm just going up the chat today. Cookie also, hey, Cookie, you're quite active today. Yeah, we're the richest country in the world. Yeah, maybe, but a lot of people aren't feeling it. And that's true, by the way, in other countries. The reason that the US election played out like it did was because a lot of people in the US didn't feel more wealthy. And, bonds are higher, of course. That's because governments around the world are going to issue more debt. And I think it's quite fascinating to see just how the bond market has changed in recent times. That's a signal of higher rates for longer. And wherever you look, the bottom line is all of this, that basically it's very much an issue that's going to play out not over weeks, but actually months. Now let's just go back to the top and just have a look. And now I've got a request here for a postcode. I saw that. Yeah, here we are. Brody Brennan asked for 4614. So let me go across and load up my spreadsheet, which is here, and cut across to that, and then put that on the screen. Okay, 4614. Okay, so this is Yarraman in Queensland, and I would highlight that this is a low count postcode. So just to be clear, when it comes below a certain level, I get a warning because my statistical analysis is 0.5% of sample. And so in a low postcode, you don't necessarily get the full picture. Okay, so just bear that in mind. And you can see there that more than half own outright. We've got some who are borrowing and some who are renting. And we don't get enough data to be able to really make good analysis on stress at the moment in this particular postcode. We can say that 95% of the houses, 95 properties are houses, and that the people ratio is 1.90. So that's the number of people per property. As the higher it goes, there's bigger families, of course. Vacancy rate is quite high. That could potentially be something to do with where it is. Are these second homes? Are these holiday homes? The average taxable income from the ATO is 62,000. From the census, it was 42,000. Again, low count, so be careful. And that gives us a disposal monthly of around 3,000, with 32% going on the typical mortgage and 34% going on the typical rent in this area. And looking at our scenarios, because we don't really have any data on stress, it looks as though on the best case scenario, property price rises could well be there. On the base case, still rises. The worst case, a bit of a fall. So that's that one. Now, before the posts started to come in, I got a request for 4109. Let's put that one in now. This is Sunnybank Hills. And here we've got 13,000 households, so a much better, more representative sample. 38% owning outright, 27% are borrowing, 34% are renting, 43% in mortgage stress, more than 1,500, 84% in rental stress, some stressed investors, overall financial stress at 45%. 83% of houses, some types of other property, including units there as well, And the people ratio is 2.75. So you can see that's a much higher, that's more families than just individuals. The vacancy rate's a bit lower at 7.2%. Now that's based on the census that was done through COVID. So the vacancy rates are always a little bit suspect. You can see that the gross investment yield is 4.3%. The net investment yield is 0.3. Gross investment is the relative between the price and the current full rental that you might be able to command in percentage terms. That's the one that all the agents quote because that always sounds good. The net investment yield, the one I quote, is the difference between the cash going out and the cash coming in for that investment property. And that, of course, tends to be less good because it includes the cost of the interest on the mortgage, if you've got a mortgage, management fees, and even things like maintenance of the property. Net investment yield is positive, 0.3 here. From a taxable income, 69,000 from the ATO and 87,000 from the census. Where we see it higher in the census, that's often more than one income going on the mortgage repayments, which gives us around $6,000 per month. Disposable monthly income, that's after tax. And that translates to 37% going to the mortgage at 2288 or 33.5%, 2044 going on the typical rent each month. On the scenarios perspective, the best case scenario over the next 3 years, a rise of 12%. The base case down 6.6%, and the worst case down 27%. And units are following on relatively closely. Okay, let's see what else I can find in terms of other questions coming in, and particularly postcodes that might actually be worth looking at. We're looking here at the posts relating to the tolls, very significant. Here's one. Postcode 2200. Okay, so this is in the area of Bankstown and includes the Canterbury SA3, Sydney in the southwest. I'm just going to take that off because it blocks it out, I realise. Sorry about that. Okay, so this is postcode 2200 with 15,600 households there, 25% owning outright, 28% are borrowing, but 45% are renting. 1/3 are in mortgage stress. 92% of those in the rental sector are in rental stress. Stress investor at 29% and overall financial stress at 58%. 38% of houses, 44% of units, and other types of property, 16%. 2.8 is the people ratio, so some families there. Vacancy rate was 8.8%. Gross investment yield, positive, 3.4%, but net investment yield is minus 0.8%. Average taxable, 63,000 from the ATO, 72,000 from the household census, which gives a disposable monthly of around $4,800 a month. And that is going to 48.7% of disposable monthly income going on the typical mortgage at 2,368, and 42% or 2,000 going on the typical rent. Those are very high percentages, and we see that with some of the lower income postcodes, that people are really up against it with massive amounts of their disposable monthly income. Now, of course, people quote 30%, but in some cases they say 30% of gross income. Sometimes they quote 30% of net income. I use it on an individual basis, but I think that this is a significant proportion of income and it's very serious. Looking at scenarios, best case scenario up 6% over 3 years, base case down 12%, worst case down 33.9%, and units following along quite closely. All right, let's see what else we can find in terms of other postcodes that we want to look at. Just going down the chat. Yep, done that one. Here's one from Wednesday Brown. Hi Martin, can you do 3040? Sure can. Okay, Essendon. Again, I'm going to take you off screen now so you can see the whole thing. So here we have 11,000 households with 34% owning outright, 30% borrowing and 33% renting. Mortgage stress at 88%. Rental stress at 75%, some stressed investors, and 69% overall financial stress. That's quite high. Half of houses, 28% of units, and there's other types of property there too. People rate is a bit lower at 2.16. Vacancy rate was 11.4%. And the gross investment yield is 3.5%, but the net investment yield is minus 0.8%. Average taxable, 104,000 versus 114,000. So you can see here that considerably higher taxable incomes relative to some of the others we looked at. That gives a disposal monthly around $7,100 on average, and 39.8% going on the typical mortgage, 2,860, and around 26% going on the typical rental payment at 1,918. Looking at the scenarios, because of this high stress and because it's Melbourne, you can see that even on the best case scenario, I'm modeling more falls ahead, 9% in the best case scenario, more significant falls in the base or worst case scenario, and units following on. And hey, Smooth, you made it. Missed you earlier on. Great to see that you actually made it in. Hope you're all right. All right, what else have we got? Any more requests coming in? Let's have a look, shall we? See what else we can find. Okay. Just working down the list. One of the little frustrations about the way that the Zoom chat works is that it jumps occasionally and sometimes I miss. So if I have missed, I apologize. I'll try and get back to you. But here's one from Glenn Martin 464565. So let's put that one in. Cut back across so you can see the data. And I will just get rid of that so you can see the whole thing. So this is Tewantin. Nice little place inside from Noosa. Spent many a happy time in that area. We have 6,200 households with 44% owning outright, 32% borrowing and 22% renting. We have 78% in mortgage stress. We have 60% in rental stress. We have some investor stress, but not very high, and overall financial stress, 42%. 85% of houses, some units and the types of property there too. The people ratio is 2.12%. Vacancy rates, more than 10%. That will probably be some holiday accommodation and also second homes. Gross investment yield is 4%. That's pretty good. But the net investment yield is 0.2% positive. And interestingly, the returns for investment properties in Queensland tend to be a little bit higher than Melbourne overall. Average taxable, 66,000 versus 67,000 from the census. That gives a disposal monthly of 4,904 with 45% going on the typical mortgage, 2,210, and 44%, 2,193 going on the typical rent. And that, of course, may not be the full story insofar that you might have people with holiday homes also living there, but these are the people living there permanently that are in these numbers. Looking at the scenarios, we see the gross move best case through 11.8% over 3 years. It's cumulative. Base case a fall of 7% and the worst case a fall of 27% in units following on behind. Okay, let's see. Deb Bartlett said, can you do 2460? I certainly can. So this is Kangaroo Creek, and that is in the New England and Northwest area. Okay, so here we've got 12,500 households. We've got 41.9% owning outright, 32% borrowing, 25% renting, 6% in mortgage stress, 92% in rental stress, some stressed investor stuff going on, and financial stress overall is 48%. 87% of houses, small number of units and types of property there. The people ratio is 2.19. Vacancy rate's 8.2%. Gross investment yield is 3.3. Net investment yield is minus 0.8%. So once again, we see people underwater from an investment perspective on average. Taxable is 64,000. The census was 60,000, giving a disposal monthly around $4,300, with 36% going on the typical mortgage at 1,560 and 34% at 1,495 going on the typical rent. From a scenario perspective, best case up 4% over 3 years, base case down 14%, and the worst case down 34% over 3 years, and units following on relatively similarly. Okay, what else? More requests. Pete asks, 2263, sure can. So this is in the Wyong area, and quite interested in some of these areas. And again, an area I know very well, including Lake Haven and Charm Haven. They have some lovely names. 10,000 in this particular area, 35% owning outright, 29% borrowing, 35% renting, 47% in mortgage stress, 81% in rental stress, some stressed investor stuff going on, and overall financial stress at 48%. 78% are houses, 10% are units and other types of property. People ratio is 2, and we have a gross investment yield at 3.4, the net investment yield at minus 0.5%. Vacancy rate was 8.5%, but that could well be some second homes, holiday homes, Airbnb, that sort of stuff. Looking at the taxable income, 65,000 versus the household census of 60,000, giving a disposal monthly around $4,300 a month, with 48% going on the typical mortgage, just over $2,000, and the typical rent at $1,745 a month, just around 40%. Looking at the scenarios, well, there is a rise. Best case, 6.8% over 3 years. Base case, a fall of 12%, and the worst case, a more significant fall, and units following along. Now, AG asked an interesting question. Can you share your thoughts on the household income ratios? What would be considered low, medium, and high? Any additional information would be most welcome. Sure. So let me just be very clear. There are lots of different ways of measuring the income ratio. And of course, what is often done is the loan to income ratio. So what's the total amount that you're actually looking at relative to income? So it used to be 3 times. It's often now 6 times. So that's one way of doing it. Sometimes called the debt to income ratio. Now, what I do is I look at it from a payment perspective. So I look at it from a disposable monthly income perspective, and I look at the percentage of disposable monthly income relative to the amount that's actually being paid on the mortgage. And that's what I use in my modeling. So to me, that's a much more accurate way of doing it, because the problem is with generic statistics, people have different situations. And if you've got a low income and you're putting 30 or 40% of it to a mortgage, you potentially will be under significant pressures. Whereas if you've got a much higher income at 30% or 40%, you can probably still manage perfectly well. Although, as I showed you earlier on, in some areas with those larger mortgages that people have, and I published some research through news.com recently that showed that there are areas of Sydney where the average mortgage is 1 million, 2 million, 3 million. Now, those have got much bigger pressures, of course. So even with those higher mortgages and incomes, you can have significant pressure. So it does depend on how you look. But there are 3 observations. The first observation is that on average, debt to income ratios are way higher than they used to be. And that's because of looser lending standards. It's because of the fact that property prices have run away relative to incomes. And I've shown charts on that before that showed that disposable income has hardly moved, whereas prices have gone through the roof. And thirdly, we've become more acclimatized to these higher debts and debt income ratios. So the old frog in the pot story, you turn the heat up slowly and people don't really notice how bad it is until things go wrong. And of course, we have this ultra low interest rate cycle, which allowed people to leverage up and borrow a lot more. That's now turned around. And that's why the amount of borrowing that you can now get for a given level of income is quite a lot lower. So those are some of the factors to bear in mind. And generally, what I say to people is you've got to work out for yourself what you think is an acceptable level of risk. Remember that when I was mortgage underwriting years ago, we used to assume a third. And in fact, we used to say 3 times the first income and maybe 1 times the second income would be the total amount that we'd be prepared to lend. Very different now. So it just shows you how the world has changed. But of course, we're up to our eyes in debt, up to the gills in debt. Interest rates higher for longer is going to have a significant pressure, and that's the final point to make here. It's not just a point in time question, it's how it runs over time. If we had a bit of a spike up and a spike down, people could probably get through it. But if we have a run up and rates then stay higher for a lot longer, it's much more difficult for people to manage, because over time, other costs start to catch up on them. And that's what we're seeing now. And so it is actually about how long rates will stay high. And my own perspective has been for some time that the RBA has made a major mistake. They didn't lift rates high enough soon enough. And we've got this sort of middle of the road sort of rate rise. So they weren't able to then start bringing rates down. And that's put a huge pressure on households. And now we've got this other set of events with Trump, meaning that rates will be higher for longer still. And that means that more people are going to get into difficulty. So you've got to look at it over time as well. And of course, the old expectation was that, well, you'd be highly leveraged on day one, but then your incomes will rise in real terms. And so you'll be able to get out of jail in year 2, 3, 5, and 10. No, unfortunately, over the last decade or so, incomes in real terms have not risen. And what that means is that people now are stuck in this high debt scenario. So I hope that helped. If you've got other questions, throw them in. I'll try and get back to you. And thanks very much for the super chat too. Really appreciate it. Okay, let's have a look. What else have we got in the chat going on? Glenn asks for 2481 and 2479. Let's go for 2481 first. Okay, so this is Suffolk Park, which around Richmond Tweed. Let me put the slide back up so you can see it and take that off. I'll come back and do the other one afterwards. Here we've got 5,200 households in the postcode, 37% earning outright, 26% of borrowing, 36% of renting, 75% in mortgage stress, 84% in rental stress, some stressed investors, 56.5% financial stress overall, 68% in houses, some units, other types of property there as well. 1.91, so it's one of the lower people ratios, so it could be some sole people living on their own as well as families and couples. High vacancy rate, so this is of course typical Airbnb, holiday home, second home areas. Gross investment yield is 3.1, net investment yield is minus 0.6%, so underwater. Average taxable 83,000 versus 93,000 for the census, giving a disposal monthly around 6,900. And looking at the percentage there, 41%, 2,860 going on the typical mortgage, or 43%, 2,990 going on typical rent. And I highlight there the rent's higher than the mortgage because in this area, cost of renting has gone absolutely through the roof. Looking at the scenarios, best case scenario, small rise over 3 years, 2.6% cumulative, but the base case a fall of 16% and a worst case down 37%, and units down 2.2% and 14 and 31% over the scenarios there. So more likelihood of going sideways or down than rising up from this point. Now you also asked about 2479. Let's put that one in as well. 2479, again in the North Coast area, but this places like Bungalow and Fernley and Opsom Creek. Here we've got 2,000, just over households, 40% earning outright, 34% borrowing, 24% of renting, some mortgage stress, but a lot of rental stress. And we see 96% of houses, small number of units of the types. The people ratio is higher, 2.42. The vacancy rate's over 10%. So again, Airbnb and those sorts of things are quite likely there. Don't really have any data on the gross investment and net investment yield, so I can't really tell you much about that. Again, the sample was too low. So when it's very low, I don't include it because it's not necessarily very reliable. But I can tell you about the taxable income, 85,000 from the ATO, 106,000 from the census. And when there's such a big gap, that there's often multiple incomes going on the typical mortgage. And that means we get a disposal monthly around $7,100 with 38% going on the typical mortgage, 2,778. and 38.3%, 2740 going on the typical rent. And looking at the scenarios, best case 10% over 3 years, base case a fall of 8% over 3 years, and the worst case a fall of 29% in units following on. Okay, what else have we got? Okay. Here's one for Fedor, asked for 2233. It's funny, you know, some postcards I can remember, others I have no idea about. Ah, yes. I knew it. This is Engadine, so south of Sydney, on the way down to the Illawarra. Here we've got 10,900 households with 39% earning outright, 49% are borrowing, high mortgage belt there, 11% are renting. 1/3 in mortgage stress, a lot of rental stress, 16% in stressed investor land, and 30% in financial stress overall. 81% of houses, some units 10%, and other types of property. People ratio is high, 2.77, so that signals families. Vacancy rate's low at 3.4%. Gross investment yield is 3.5%. Net investment yield is minus 0.7%. The average taxable, 84,000. The average census, 124,000. Once again, showing two incomes going to pay the mortgage. Disposal monthly, $7,200, with 42% going on the typical mortgage, more than $3,120 a month. That's high. And on the rent, 34% or $2,492 a month going on the typical rental payment. And looking at the scenarios, best case, rise of 6.2% over 3 years, base case, a fall of 12%, worst case, a fall of 33%, units following on. Okay, yet no. And yes, just confirming, when I'm doing this calculation, I'm doing it based on taxable income. So basically what I say is, tell me about all of the income that you're getting from all sources. Tell me about what goes through the tax processes. So what have you got to spend? That's the way I do it. And that available spending income is then what I run everything else off. The reason I do that is because if you think of it from a genuine situation, that's actually the way it actually works, because tax gets whipped out probably on the way before you ever even see the money, as other things do too. So in a way, you can't really count superannuation, you can't really count what you pay in tax in the overall income story. So it's what you have in available cash to spend. That's how I do it. Okay, here's one from G2 Cali, 3844. So let's put that one up. Okay. Put the slide back up so you can see it. Get rid of your chat so you can see the whole thing. So this is Traralgon, is that right? Or is it Traralgon? Maybe Traralgon. 13,000 in the postcode. 35% owning outright, 40% are borrowing, 24% are renting. And that gives us 78% in mortgage stress, 74% in rental stress, some stressed investors, 51% in financial stress, 87% are in houses, some units and other types of property. People ratios 2.18%, 8% vacant, 3.3% gross investment yield, net investment yield, minus 1.8%. Yeah, unfortunately, I'm seeing this a lot in and around Greater Melbourne. So people are losing money on investment properties on a cash flow basis. 80,000 ATO, 80,000 from the census, very close, giving a disposal monthly around $5,800, with 27% going on the typical mortgage payment, 1,589, and 23.5% going on the typical rent, 1,380. Now, this is a classic example. The overall percentage is lower, but because the income is lower to start with, people are still having financial pressures. So it shows you the story here. I have a Traralgon. Thank you very much. Appreciate that. I'd like to try and get it right. And AI makes the point using gross income is ludicrous. Absolutely, but it's the one that is often used simply because it masks a lot of pressure. That's why I do what I do. I look at the real information, real money. It's because this is a cash flow. It's like any business, money in, money out. Okay, here's one. 32483 is the next one. Okay, this is Brunswick Heads. Get rid of that so you can see it. 4,700 in the postcode. This is households, of course. 38% owning outright, 32% borrowing, 28% renting. 85% in mortgage stress, 80% in rental stress, some mortgage stressed investors as well. 54.5% overall, which is quite high. 82% of houses, some units are types of property. People ratio is 2.12. Vacancy rate is 12.2. That includes Airbnb and other bits and bobs, I suspect. Net investment yield is minus 0.8%. Average taxable 67, household census 74, giving a disposable monthly of 5,554, with 41% or $2,278 a month going on the typical mortgage and 43%, $2,392 going on the typical rental payment. Scenarios: best case up 3.1%, base case down 15, worst case down 37, and for units somewhat similar. Interesting. Thanks for that comment. Thank you for doing 3040. Essendon is earmarked as an activity centre, and the Victorian government plan to continue to destroy the suburb with high-rise dog boxes and medium rises everywhere. Yeah, this is a major issue. Of course, Victoria is rolling out this high-rise land. It's crushing the quality of life for many people. It's increasing the amount of traffic that's going around. And it also is displacing people as well. So unfortunately, we're seeing similar things in and around Sydney, although some of the councils are pushing back. And this whole strategy is nuts, not least because if you ask people what they want to live in, it's not dog boxes. And of course, they're poorly built. They are often going to be high to maintain, and the strata fees are going through the roof. It is a mess. Okay, Nathaniel asked for 4032, which we can do. Put that back up. 4032. Thank you for asking for this one. This is Chirnside West in the Brisbane and Moreton Bay area, 8,500 with 22% owning outright, 24% borrowing, 52% renting. 55% in mortgage stress, 76% in rental stress. So we've got more than 3,400 in rental stress. 30% in stressed investor land, giving 58.4% overall financial stress. That's quite high. 40% of houses, 42% of units, some other types are probably there too. People ratio is just over 2. Vacancy rate 6.4. Gross investment yield 4.1. So once again showing that the returns up in the Queensland area are higher. Net investment yield is positive 0.5, giving an average taxable of 73,000 versus 82,000 for the census. Income 6,150, giving a 36.8% going on the typical mortgage at 2,263 or 31.2% at 1,918. From a scenario perspective, best case up 10% over 3 years, base case down at 8%, worst case down 29%, and units following on. Nathan asked for 6155. Okay, 6155. So this is Canning Vale. Okay, and here you can see here we've got 17,900 households with 1/3 owning outright, 47% borrowing, very high, 18% renting, 72% in mortgage stress, 88.9% in rental stress. We've also got some stressed investors and 55.8% overall. 92% houses, small number of units, other types of property. 2.94, so a lot of families there in that area. Vacancy rates 4%. Gross investment yield 4.2. Net investment yield 0.6. And looking at the taxable, 82,000 versus 116,000. So again, two incomes at least going on the average mortgage payment, giving a disposal monthly of 7,478 with 32.1% going on typical mortgage 2400 and 28% 2090. Sorry, 2093 going on the typical rent. I said 2090 because that's my postcode of where I used to live in Sydney. So it's slipped in through the brain there. Can you believe that? Okay, where are we? Have we done 4370? I don't know. One feature I haven't put into this program yet is to flag it when I've done it on a show. I should probably do that at some point, but there's so much coding to be done. I wasn't sure it's worth it really. So let's have a look. Don't think we did it because it's in the granite belt, and I don't remember the granite belt being called out. So let's do that one. 4370. 8,000 household, 39%, owning outright, 31% of borrowing, 29% of renting, 81.5% in mortgage stress, 82% in rental stress, 29% in investor stress, 55.8% in financial stress, that's high again. 88% of houses, small number of units and types of property, 2.11 is the people ratio, vacancy rates 10.6%, gross investment yields 4, net investment yield is minus 0.2, average taxable 64,000 versus 59,000, and looking at the percentages, 36% 1560 for the mortgage payment, 30% $1,296 a month for the typical rent. Scenarios: best case up 6.3%, base case down 12.6%, and the worst case down 32%, and units following on. Okay, well, I reckon we may have come to the end of the questions. Let me just check to see I've not missed any, because I could well have. As I say, this here is, I did that one, I think, yeah. Okay, if I have missed any, stick it back in quickly and I'll try and get it sorted out. Dylan asked for Bundaberg. I haven't done that one, so let me do that one. 4670. We're running out of time anyway, but I can be a little bit flexible because one, we've got a time change here, so it's earlier, and two, I don't have a guest on who's often time constrained, so it's all good really. Okay, Bundaberg. This is, of course, one of my stress highlights. It's a big area. I just make that point. It's a very big area. 35,400 people there across the postcode 4670. 39% owning outright, 30% borrowing, 29% are renting. A quarter in mortgage stress, 89% in rental stress. Some stressed investors, overall 41.4%. We have 83% houses, some units, other types of property. The people ratio is 2.18. Vacancy rate's 8.4. The gross investment yield is 4.4. Net investment yield net investment yield 0.2. I was trying to make it minus there. I don't know why that was. 70,000 from the ATO, 62,000 from the census, giving a disposal monthly of 4,328 with 36% going on the typical mortgage at 1,560 and 32.8% going on the typical rent at 1,420. And the average taxable and the household census data shows me that people are under severe pressure here. You can see here at 36%. These are quite high proportions. Looking at the scenarios, up 13% best case over 3 years, down 5%. Sorry, up 13.1% best case. Base case 5.8% down. Worst case down 26.4% in units following along. All right. I think we're pretty much there at the end of the show now. So I'm going to cut back. Jason's, thank you very much for the super chat. I really appreciate all of your support. It really is greatly appreciated. It helps to make this run. And without it, it would be very difficult. So thank you once again. And yeah, as Jason says, please like, share, whatever you do to help get this noticed, it really helps me. So please like these shows and share them. And feel free to contribute via Super Chat if you'd like to. Jason is absolute star here, so thank you very much for that, Jason. Okay, Kim asked for 4208 Umaru, which I thought was in New Zealand, but maybe I've got that wrong. Maybe there's another Umaru over there. Okay. Maybe I misread it, but there we go. Let's put that up. There you go. Because I can. 8246 households, 21% earning outright, 53% borrowing, 20% renting. Those in mortgage stress at 15%, those in rental stress at 86%. And this is showing that stressed investors are at 20% with financial stress at 35%. 93% of houses. Small number of units, other types there as well. People ratios 2.93%. Ormo. Thank you very much, Hammers. Ormo. Oh dear. I don't know. Gross investment yield 4.4. Net investment yield is positive 0.5%. Giving the taxable at 74,000. The household census at 111,000. So you can see there multiple incomes going on that mortgage. Disposal monthly 7183 with 33%. 2,400 going on the typical mortgage and 30.9% to 217 going on the typical rent. 15.1% up, best case scenario over 3 years from a price scenario perspective. The base case a fall of 3%, 3.9% actually, and the worst case a fall of 24%. There you go. Kim says, thank you very much. You're very welcome. Glad I can help. Okay, so let me just put that back on me for a second while I go back across over here. So I hope you found that interesting and informative. As with all of these shows, what I'm trying to do here is to give people a little bit of a sense of what's going on. What I should remind you, I didn't do this earlier on, but will just remind you now, of course, I'm not providing financial or legal advice on this show, and I do moderate the chat. And if you want to get my attention, use all the work which you've been doing, and I've enabled Super Chat. But the main point here is just to remind you that this is not financial or legal advice. This is just my general analysis, and that's really, really important. So if I just then come to the end of the story here. So given that there is significant pressure on households and it's likely to be maintained, one of my observations is that some people are still looking for the government to sort of save the day, or the RBA to save the day. My expectation is that we are going to see these interest rates continuing higher for some time. I expect that the cost of living will continue to bite, and I expect that real incomes will continue to be squeezed. So there isn't an automatic escape route for what we're seeing here. And given what I said about tariffs and those other things, it's likely to get worse rather than better. So it comes down then to people being to take ownership of their own finances. Some do, of course, but in my surveys, less than half actually run their own cash flows or understand where the money is coming in and where it's going out, which is an interesting observation. It hasn't improved. And interestingly, from a demographic perspective, quite often what I find is that those who are under more financial pressure actually know less about their finances. So one of the observations I do make is it's really important to build a cash flow, understand there are actually some models that you can use. The Money Smart website from ASIC includes some which are quite useful, but just a spreadsheet works quite well, or you can use some apps to do it. Where's the money coming in? Where's it going out? And then understanding where you're prioritizing appropriate. Because the fact of the matter is that quite often what we're seeing is that people are prioritizing things that are not necessarily must have, they're nice to have. So I think of some of the subscription services for video streaming, for example, or even some of the more extensive plans for phones. Those things, well, they're nice to have. You could perhaps skinny them down a bit. Now, if you are in difficulty and you have a mortgage, of course, the banks are obligated to provide some help and support through their hardship schemes. Just a quick warning here, those hardship schemes are quite often actually designed to help the banks, because if the banks can actually extend the mortgage, they don't need to, and you can continue to make the payments, you then don't need to appear in any of their bad debt numbers. So they're very keen to help for a period of time. But ASIC showed that tended to extend the problem for a period, but didn't solve it. Quite often, you end up paying a lot more interest over time. But nevertheless, it's worth talking to your bank. Of course, if you've got a rent situation, depending on the landlord. Some are quite helpful, and I've spoken to a number of landlords who have not put rents up because they're concerned about their tenants. Others a bit more Machiavellian and just put them up and say, well, if you don't want to pay, get out, we'll get somebody else. And of course, that's still going on at the moment. However, it is worth highlighting that you can get help if you've got financial pressures, whether you've got a mortgage or whether you've got a rent. It is sometimes very useful to talk to somebody who potentially help. Be careful here, though, because unfortunately you can go on to the internet and sort of Google debt help, and you'll end up with all sorts of weird sites where they might even charge you for advice or, in fact, take you for a ride. Don't do that. There is one that I always recommend, and that's the debt helpline. And the debt helpline, of course, is the government-backed scheme. Here it is. The debt helpline number is 1-800-007-007. Very important to take a note of that if you think that you have pressures and difficulties. They are very busy, of course. Everyone's saying the debt helplines are absolutely under pressure at the moment. But nevertheless, that is a very good source of assistance, and I do recommend that. Another source of assistance, which is quite useful, is over on the AFCA site. That's the Ombudsman, basically. There is a statement of financial position tool which allows you to put in information, and that information allows you to calculate what you earn, what you owe, what your expenses are, and all of that stuff. And then you can create a form. That form is very useful if you go to somebody to the debt counselor or to the bank, but it also structures your thinking. So that's quite a good source of help. You can Google it there. It's called the Statement of Financial Position on the AFCA site. Recommend that. And again, it's worth doing a bit of work to prioritize effectively. If you've got very high debts with big interest rates on it, they're the ones to look at first in terms of trying to get rid of them relative to others. The other point I'd make is that quite a few people actually end up reaching for more debt. And unfortunately, over my long experience of this, what I find is that people get into more and more difficulty. And it's like quicksand. The more you struggle, the more debt you get, the more you sink. So sometimes it's really important to sort of understand that there's a more serious strategy that needs to be adopted. And as I said earlier on, some people have now decided they need to sell and get out if they've got a mortgage they can't afford, because rates are going to stay high for a lot longer. So that's an important point. Now, just a couple of points before I go. If you want more information about my modeling, and if you want to get access to the full set of more than 2,000 postcodes, which I update every month, it is available via our Patreon program. And there are various levels of support, and I do say thank you for all of those supporting us via Patreon. Again, if you'd like to make an ongoing contribution to what we do, it's a very simple way of doing it. It really is appreciated. But specifically, the $50 a month tier is actually where you get access to all my data. It's in a comprehensive spreadsheet that you can then query and pull information out, just like I've been using. It's the same model, it's the same approach, but for all postcodes. And that's updated each month. For those who have contributed at this level for the last month, I'll be sending out my full update in the next day or two. So look out for that. And encourage you, if you are interested in getting the full information, you can also make comparisons. And that information includes all of the gross information, net information on the investment properties, the scenarios in terms of where property prices might be moving, and all of the other stuff that you saw in my model is available via the Patreon program across all of the postcodes of our model, updated every month, of course, as I may have said before. And just to say also, of course, my blog is also there as well. If you want to contact me, relating to the one-for-one conversation, or indeed more information, all of my posts go up on the blog, and you can also there listen to a lot of the shows too. So it's digitalfinancenews.com/blog. Oh, and I also do invite people to contribute via PayPal. If you'd like to make a one-off donation to what we do around here, you can do that via the PayPal, and the link is there. And actually, I even do have Bitcoin at the moment. And given the trajectory of Bitcoin at this time, it might be quite interesting. And just to give you the latest on Bitcoin, I noticed that here we are. The Bitcoin is at 87 575 at the moment, continuing to shoot higher, and well, we'll see where it goes. Not going to talk much more about Bitcoin tonight, but I did make a show yesterday about that. Anyway, I think we've come to the end of the show. I want to say thank you very much for spending some time with us this evening. I hope that you found it useful and informative. I think my message for everybody is don't panic. If you are in financial difficulty, start recognizing it first and then beginning to structure it. There are things you can do. And as with all of this, unfortunately, people are digging their holes deeper, unfortunately getting into more difficulty. I don't think necessarily buying more property is necessarily a good strategy for many at the moment. The full story on all of this is going to play out over the medium to long term. Anyway, thank you very much for spending some time with us this evening. The doggies are back in their box now, so they've sort of wound themselves up. They look very cozy and comfortable, so they haven't done anything. Now, next week, Cameron Murray will be on, and he and I will be talking about some of his latest research, fresh economic thinking, of course, and also talking specifically about some of these so-called solutions to the rental market and why they aren't really solutions at all. So check that out. And of course, check out my live shows every Tuesday. We had an occasional Thursday one last week with Chris Bates as well. If you've not seen that, check that one out. Every Tuesday at 8 p.m. Sydney time. But I make daily shows and they go up every evening. Because of the time change, it's now 2 hours different, which means they tend to go up later, about 10 p.m. Sydney time, just because it takes me time in the morning to make them. Anyway, look out for those. And thank you very much for spending time with us this evening. Thank you for the super chats. Thank you for all the questions and for the requests. Keep safe, and I'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics signing off. Take care. Bye-bye.